Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 11th of September 2019, and we're looking at the reasons why silver in particular suddenly jumped up again this morning, above the $18 level. We also discuss gold and interest rates, and the upcoming ECB and FOMC meetings. So let's investigate. In our weekly update published last Saturday, we stated that we expected gold to move down below $1,500 this week and silver below $18, heading potentially towards the vicinity of $1,750, whereas at the time gold stood at $1,507 and silver at $1,818. Well, on Monday and Tuesday we witnessed a fall in the gold price to as low as $1,484. and silver to $1,778. However, in the past few hours, we have seen a slight rise in both of these from those lows, with silver standing back above the $18 level at $18.09 and gold at $14.91. Both levels still lower than Friday's close. But why the jump today? Now, we have to admit that the rise is still relatively small and could easily reverse, but silver is interesting if only because $18 is psychologically important, particularly to the silver bulls. If silver can hold above this level, they foresee it using $18 as a base or floor or support from which its next upward move could be launched. And to be fair, we would not disagree with this philosophy, providing $18 holds. So let's look at what is happening, at least so far today, which of course once this video is published could change, but the messages underlying this are important to note. There are two very important dates as far as both investment and precious metal analysts are concerned. Tomorrow, the 12th of September, and a week today, Wednesday, the 18th of September. Tomorrow, because the European Central Bank is meeting to discuss and agree its policy on interest rates. In fact, it's Mario Draghi's last meeting that he will preside over as the president of the ECB. Overnight index swaps have priced in a 100% chance of a 10 basis point cut and a 46% chance of a 20 basis point cut tomorrow for European rates. With Germany teetering on the edge of a technical recession, and it being the largest net contributor to EU funds, market expectations are that the ECB will be more dovish tomorrow than hawkish. We've already reported that it has intimated that now is not the time for it to embark on aggressive bond buying, i.e. QE. But a small cut in rates would indeed send a message to markets, even though we are of the view that in reality 0.1 or 0.2% fundamentally affects little, but makes a statement of intent. Now, Margaret Yang Yan, a market analyst at CMC Markets, told Bloomberg today, quote, "The ECB is expected to reduce further the interest rate into negative territory. The meeting could serve as a potential catalyst for gold, and investors are already buying into the rate cut expectations. Given that gold has had such a deep correction from its recent peak, investors are buying on dips." Unquote. This then leads us nicely on to the second important date. Yes, you've guessed it, the FOMC meeting announcement due next week. With the dollar index still riding high at its current level of 98.5, there will be considerable pressure on the Fed to reduce rates, especially if the ECB lowers theirs tomorrow. In fact, yesterday, Wells Fargo analysts have predicted a 25 basis point cut to the Fed funds rate especially bearing in mind the relatively market-supportive comments made by Fed Chair Jerome Powell at his meeting in Switzerland last week, and the relatively poor non-farm payrolls report. In fact, markets are pricing in a 100% probability at this stage that rates will decline by 25 basis points. Between now and then, we still have US economic data to contend with, including CPI, core CPI tomorrow, and retail sales and the Consumer Sentiment Index to be announced on Friday, and industrial production next Tuesday. Now, talking of next Tuesday, we should also not forget an important political event, namely that the next round of US-China trade talks takes place, but a White House advisor has urged investors, businesses and the public to be patient about resolving the trade dispute, therefore dampening down expectations. So, these are the expectations, which frankly will prove mildly bullish for gold and silver. However, it would be remiss of us not to alert you to the fact there are some who hold a contrary opinion. Financial journalist and author of ETFs for the Long Run and Investing in Dividends for Dummies, Lawrence Carroll, recently penned an article for Forbes magazine stating that he hopes the Fed chair will not cut rates in September. Here are some excerpts from his article. Quote, "In July, the FOMC cut the federal funds rate, basically the nation's interest rate, by a 1/4 percentage point, to bring the rate down to a range of 2% to 2.25%. There really wasn't much need for a rate cut, but the stock market had been volatile on rising trade tensions and a slowdown in global growth. The interest rate on the 10-year US Treasury bond, the market benchmark, forecast a rate cut, and many traders and pundits were calling for a full percentage point of cuts as insurance for the economy. On top of that, President Trump had been berating Powell on Twitter, saying that he was too slow in cutting rates. So Powell cut rates. It seemed to me that he had been bullied into it by both the president and the market. He called the rate cut an insurance policy against potential speed bumps for the economy. The problem with this scenario is that cutting interest rates won't solve the trade dispute or the effects of the tariffs. Cutting rates is supposed to make money cheaper to borrow, which can then be invested in companies and the economy. But there's no liquidity problem. Money is pretty cheap right now, and it hasn't been sparking capital investment. The reason is corporate chieftains like to invest in an environment where they have some idea what the future should hold. But with a president who can issue conflicting orders in the same day, these business leaders have no idea what kind of environment they're investing in. On top of that, when markets are volatile and spark fears of recession, companies tend to hold on to cash in preparation of a rainy day. So making money cheap isn't going to fix this. Maybe even more important, at 2%, the Fed does not have a lot of room to cut rates if the economy really does begin to fall. If they waste a rate cut now when it's not necessary, it could make things worse when it is necessary. So I hope at the next FOMC meeting, Powell shows some backbone and just tells the president and the market that all the economic signs look good and he's not going to cut rates just to make the president feel better. If the president wants the economy saved, the trade war will have to end, and he's the only one who can do it, unquote. Generally, we agree with Carroll, though we would like to think and certainly hope that all of this pain being suffered will be worth it in the end, with an eventual trade deal more beneficial to the United States and hopefully the rest of the world obtained. But that said, we are where we are. And while global growth is suffering, and President Trump appears immovable on tariffs, at least for the moment, and President Xi in a similar frame of mind, all the Fed can do is reduce rates to help minimize the adverse effects. Now that said, and one should not ignore this, any reduction in interest rates are likely to result in a reduction in the value of the dollar, thereby making American imports even more expensive. And being a net importer does not help the economy short term. The saving grace, of course, for the US dollar is that so many other currencies are devaluing too, thereby minimizing this potential harmful effect further. So meanwhile, while a number of global tensions have receded, and Bolton, the military hawk national security advisor, has left the White House, making a more accommodative approach to North Korea and Iran more likely, one would have expected gold and silver prices to fall further. For now, however, it's trade and interest rate policy which is dominating the agenda. And whilst this continues, and the prospect of lower rates occurring, we will see an underpinning of prices. Of course, if Carol is right and rates are not reduced next week, and the ECB surprises markets and does not reduce rates tomorrow, though both of them frankly are unlikely, then we shall see a further strengthening of the dollar and a reduction in gold and silver prices. But we have to admit that that likelihood is very slim, albeit a possibility, very slim nevertheless. What do you think? Do share your views. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.
Glory, glory, hallelujah.